Good morning, good morning, good morning. It is the morning blast with myself, Ryan, and of course, Michael. It is what is it? It's the 12th of February, Thursday, all day. Join me and Michael Brown for a candid look at markets, what happened yesterday, what is to look forward to today, etc. The usual caveats apply. Nothing discussed on the podcast is trading investment advice. We do not apologise for the use of foul language on fruity takes. Yeah, you know the score by now. Hopefully we had a bit of value to your day, put a smile on your face. Michael, how are you on this lovely Thursday morning?
Yeah, very good morning to you, mate. Good morning, everyone. I am all right, actually. It's just looking forward to getting to the end of the week, to be honest with you. I mean, how is it only Thursday still?
Well, yeah, you say this. Yeah, I think Tuesday I was thinking it was Friday, but there you go.
Yeah.
We will. We'll start. We might as well just before I just quickly start with Clive Lambert's marvelous update on markets and levels.
Oh, well, I'm glad you said that. I was starting to worry we didn't have one because I hadn't seen one come through.
No, I panicked as well, and then I checked my email. But it just to hold a thought for Rachel Reeves, already been out the gates this morning, tweeting away that the economy is booming and the Bank of England are cutting rate. Well, Labour claiming that they're taking credit for cutting rates, completely ignoring the fact that rates are being cut due to a worsening economic outlook, etc., etc. You couldn't make it up. It's gaslighting to the highest degree, but we'll come on to that more in a minute.
Well, there was also a fella on Bloomberg earlier, some junior Treasury minister, looked like he'd just come out of school, to be honest with you. But he was saying that growth is okay, but we're going to go further and faster. Well, actually, fucking do something then. Stop just saying this, and actions speak louder than words, lads.
No, exactly that. But we'll come on to that momentarily because it has been dreadful.
I can feel my blood pressure rising.
I can feel it through the phone. Right. Market update from Clive Lambert at Futures Techs. S&P struggling to see off that 7,000 level for now. The all-time high is up at 7,043. Yesterday was another mixed session with the DAX. Also, one second, I'm going to sneeze. Oh, not. The DAX is still shy of gap resistance at 25,322, but the Eurostoxx 50 and the FTSE have no such worries. Both making new all-time highs yesterday. Bund futures that dipped to 128.39 on the jobs numbers yesterday, and then recovered. Dollar yen eyeing support at 152.09. Bitcoin back below 70,000, so looking likely to retest 58 to 60,000 support levels. Gold, the yellow metal, is hanging around 5,100 for now. Silver, that gave 84.74 a test yesterday, but got a bit of a nosebleed up at those levels and pulled off slightly. Everyone loves a good pulling off story.
Oh,
Palladium tried to move through the 1775 level, but found some sellers. Dr. Copper back above 130.30, so that should be a cheer for the bulls. It is, but hasn't yet. But just hasn't yet. Gains to 13,480, finding sellers yesterday. Brent crude posted a shooting star candle yesterday on hitting resistance at 70.58, so that might worry the bulls a little bit. TTF, which is European gas, posted a mixed session yesterday, a small win for the bulls, but an early bid today has already found sellers. European carbon markets posted a hammer time yesterday, but is offered this morning. Basis some comments from MERS after hours yesterday. 76.10 is key support and 73.96 is a target below that. And finally from Clive in ag space, soybeans bid again after a dip to 11.13, found buyers yesterday. Soybean oil, so this is after it's been crushed, is eyeing the big resistance at 580 to 581. Wheat bulls had a good day yesterday, and that's back above 540. Michael, take it away.
very good.
I'll tell you what we'll do, because there's a couple of things to talk about today. Let's talk about yesterday. Let's talk about we can have a little bit of a dive into the NFP number, and then we can talk about today's what to look for today. But also, before we do that, a bit of a dive into the dreadful UK data. How does that sound?
Yeah, sounds perfect to me. We will do the jobs data in approximately 90 mention, first of all, and apologies if I left you briefly, my phone started ringing. As for other things besides the jobs report yesterday, which we'll go on to in a second, the first notable headline came via some Bloomberg reporting on the trade front, noting that President Trump has reportedly been mulling in private whether to quit the USMCA trade deal. This is according to people familiar with the matter. Trump has been asking aides whether he should or shouldn't withdraw. I would flag two things with this. Firstly, the actual text of the agreement says that you need to give 6 months notice for a party to actually pull out of the deal. The second is that the USMCA deal is scheduled to be renegotiated starting in June anyway. So this feels very much like another one of those escalate to de-escalate gambits to try and get a little bit of negotiating leverage in those talks that are going to take place.
Firstly, we love a good pull-out story on the show. But what I would say, I wouldn't hold too much to the fact that legally you're meant to give this amount of notice, because Trump does what he wants, basically. I'm not saying I do agree with you. I feel like this is an escalate to de-escalate, but he could very easily just turn around and say, well, fuck your rules.
No, you are correct on that one, and he has got form in doing that. But yeah, I do think that's very much a case of we're just trying to get a bit of negotiating strategy going. And yeah, I'm going to say it again: go and read the fucking book if you haven't done so already. Exactly. What's your excuse? A couple of other things just before we get to the jobs report on the geopolitical front. The Wall Street Journal reporting yesterday that the United States is preparing a second aircraft carrier to deploy to the Middle East. Of course, the USS Abraham Lincoln is already there. These officials that they were citing said that there hasn't yet been an official order to deploy a second carrier and that plans could change, but it is nonetheless noteworthy that this is the kind of direction that their thinking is going in. The other thing just to bear in mind is that it would probably take somewhere between 3 and 4 weeks for a carrier to get from the US, where it's based, over to the region in the Middle East. So again, if we're thinking about when or indeed if things could escalate, that's the kind of time frame that we're looking at. And lastly, just a bit of corporate news here in London this morning, quite a big one actually. Schroders are being purchased by Nuveen, so another example of a US firm coming in and snapping up UK companies on the cheap. Schroders trading as much as 20% higher in early deals this morning.
Lovely.
Should we do the jobs report?
Let's do the jobs data. So just for those that might have been living under a rock, yesterday we had NFP. Obviously, the headlines were beat, but obviously, as always, it was always worth diving under the hood. NFP came out at, what was it, 130?
It was, yes.
Versus a 70,000. I said that like I didn't know. But I don't know why I said it so wrong. Was it?
I can tell you what, it was way off my guess of 25, that's for sure.
Well, exactly. And our friend Batesy said negative whatever it was he said.
Yeah.
So NFP data came in at positive 130, plus 130,000 versus the 70 expected. The whisper was around 40,000 because of obviously the front loading from.
Right. Can I have a rant about that?
Go on.
So the Bloomberg whisper number, for anyone who isn't aware, it gets a lot of media attention.
Maybe by those who don't understand what it is.
Well, exactly. And I'm going to tell you exactly what it is. If anyone's ever worked on a trading floor or a broking floor, you'll all know that on non-farm payrolls Friday, someone will come around with a cup or a hat or something like that, or you'll be writing your payrolls guess up on a board, and whoever's closest wins a pot that everyone's thrown a fiver into. That is basically what the Bloomberg whisper number is, just on the Bloomberg terminal. Anyone with a terminal can go on to WHIS Go and just type in their payrolls guess. It's not some kind of insider information coming out of the back of the BLS as to where the jobs number is going to be. It's simply where folk like me with a Bloomberg go, actually, do you know what? Just for a bit of fun and maybe some bragging rights on the terminal, I'm going to throw my payrolls guess in there as well as putting it on my Twitter.
I've actually seen people but you can tell they're like new to Bloomberg, see that number or see it in a screenshot someone else has posted and believe that this is like the inside number from someone within BLS.
Yeah, it categorically is not that, and don't let anyone tell you that it is.
But yeah, so the NFP numbers on the face value, like unemployment down, average hourly earnings a bit hotter than expected, etc., etc. So on paper, good numbers. But, and there is a but, as Michael said, Michael, as always, calls it beautifully, check under the hood and check where these jobs are coming from. Healthcare added 82,000. And as we said, as Michael said in yesterday's show, that's significant because it's, they are kind of, I'm not saying unproductive jobs, but they're jobs that are kind of to look at, they're jobs that are being created because of unproductive people, if you want to look at it that way.
It's almost a mechanical increase in employment.
Yes.
No matter what happens with the economy, the healthcare sector is just going to keep adding, basically.
Which is not a sign of a strong, growing economy, really, when basically the only people getting employed are those to help people that are very much not productive. But one thing that's I've seen a lot of people comment on this 82,000 level, Michael, for the healthcare. But what I've not seen anyone really talk about is the second biggest, sector of employment was social assistance. Now, social assistance is basically just an additive to healthcare.
Same thing, isn't it?
Yeah. And that's 42,000. So we're looking at 124,000 was made up purely of healthcare and related social assistance kind of jobs, whereas manufacturing only added 5,000. Federal government lost 34,000, and this is being put down to the deferred resignation program kicking in. Financial services down 22,000. So what do you make of that?
Yeah, and I think that's really the big story of the jobs report for me. It's a case where, as you kind of said, the headline numbers, you look and when you sat at the desk yesterday, 130,000 on the payrolls print. Wow, that's a really hot number, smashed right at the top of the range of estimates that have been submitted from economists. But then, as you rightly say, you dig into the details, and actually, I think the breadth of hiring is still very, very narrow.
Yeah,
if you look at all the sectors that the BLS sort of categorize into 11 different sectors of the economy, 5 of them shed jobs month over month in January. So what we're seeing is, fine, headline payrolls massively beat expectations, double consensus, whatever. But those job gains are not being, spread out on a broad basis across all sectors of the economy. They are very, very concentrated in, as you rightly said, mainly healthcare, which is basically the story that we've had in terms of the US labor market for the last 6, maybe 9 months now. I think
exactly that. It's quite like healthcare is just carrying healthcare and health-related social services, etc., are carrying the entire US labor market at the moment.
Yeah, absolutely. Although having said that, I do think that the household survey painted arguably a much more positive picture. And actually, we can rely on that a little bit more than we can the establishment data, as we rightly were talking about yesterday. Because if you look at that household survey, unemployment came down further to 4.3%, down from 4.4 in the prior month and down from 4.5 in November. We also had an uptick in labour force participation, which rose to 62.5%. And that's important because that dynamic means that unemployment is coming down, which means people are finding employment. Participation is going up, which means more people are coming into the labour force to try and look for jobs. And the reason why we need to focus on that is because this is what the Fed use in their models to try and gauge the degree of slack in the labour market. As we mentioned yesterday, the Fed don't really, well, they do care, but they're not going to set the Fed funds rate based on whether payrolls rose 30,000, 60,000 or 130,000. No. That's not how this works. They're looking at the slack that's in the labour market or isn't. And the way you gauge that is by looking at things like the participation rate, which is just shy of cycle highs. So I think from a policy perspective, the report was enough for the Fed to say, obviously we get the February data before the March meeting anyway, but it was enough for the time being for the Fed to go, our wait and see approach is probably about right for the time being. Exactly. And we did see markets price out, just last, I think we were about 20% of a March cut with the next cut in June. We're now at about 5% of a March cut with the next cut fully discounted for July. So we have seen markets adjust a little bit on the back of that.
Yeah, as you said, we've seen markets adjust, but anyone going out there saying this kills the rate cut story, I think, calm it a little bit. But one to definitely keep an eye on. Obviously as well, let's not forget the big number of yesterday was the benchmark revisions, which was just shy of 900,000. So basically they overcounted in 2025 to the tune of nearly 1 million jobs.
Yes.
So that's a significant reduction. So one to keep an eye on. Like we said, in my opinion, that's what kind of the Trump administration officials were kind of leading when they were saying, expect some dodgy numbers. But to be fair, it doesn't feel like really anyone. I was surprised by the lack of people that picked up on that number because I was expecting talking heads to be taking that completely wrong. And, I'd have loved it to have been more over 1 million because that would have just been hilarious. But one to keep an eye on. Look, yes, rate cuts are less priced in now, but they're definitely, it's still a story. It's like,
Yeah, I mean, it's very clear that the Fed are still going to take further steps back towards neutral as the year progresses. They are likely, you would imagine, to come once Kevin Walsh takes over his chair. The way to look at it is you've got to think, why were the Fed cutting last year? The 25 bip cuts that they delivered in September, October, and December last year, they were being framed as essentially insurance cuts. We want to ease off on the restriction just a little bit, give the labour market a little bit of room to breathe, take out some insurance, protect a little bit against any downside employment risks. From the Fed's perspective, they would go, well, we've taken out that insurance. We delivered 75 basis points of easing. So we think, and they stood pat in January, so they clearly think they've taken out enough insurance for the time being. On the labour front, the question is now that they will be asking themselves is, do we need to take out more insurance? And the report that we got yesterday kind of says, well, actually, no, you've probably done enough for the time being.
Well,
again, the February data could say something completely different, and we'll get that in a few weeks' time. But for the time being, that's the message.
I'm glad you mentioned that, because the fact that it appears that, the fact that we are repricing, to the not to the upside, but the fact that we are taking rate cuts out of the market pricing at the moment based on these numbers and stuff, you could argue very easily that the Fed have actually played a blinder so far, because they've been, small cuts here and there when they feel like it's needed. The market isn't, the economy isn't collapsing. So, people were saying they should have cut harder, etc., being proved wrong. They've done enough. It just feels like they've played it very, very well. The fact that we're seeing data like this and it's like, oh, do they cut? Do they not cut? It's kind of indicative to they're probably priced right if we're having these discussions.
Yeah, I think you're absolutely right. Shall we go to the UK numbers?
Oh, if we have to.
Yeah, so for those who are, again, unaware or living under a rock, we had the fourth quarter GDP data out of the UK this morning. The economy, well, I'm going to say growing, although it's not really growing, expanding by 0.1% on a quarter-on-quarter basis. That was unchanged from the pace of expansion that we saw in the third quarter, but below both market and the Bank of England forecasts for 0.2% growth, which still is hardly worth shouting about. On a year-on-year basis, that saw growth of 1% in the fourth quarter. That was down from the 1.3% that we saw in the third quarter of last year. But I think what's really...
Whoa. Well, no, wasn't it? I think the third quarter was revised down to 1.2.
Oh, was that revised lower as well? Oh, I must have missed that. Sorry.
Yeah.
Well, that's even more bad news.
Yeah.
But I think what was even more instructive than the figures themselves that I just outlined is actually the breakdown of that GDP report. So the ONS reported that production rose by 1.2% on a quarter-on-quarter basis in Q4. That is almost all or largely as a result of auto production having resumed at Jaguar Land Rover. They obviously suffered a cyber attack in September of last year. That came into the Q3 numbers and dragged them lower. They then reopened and restarted production in October and primarily in November. And of course, that then boosted the production data for Q4. So it's a mechanical rebound more than anything.
Yeah.
The services sector activity was flat. As the ONS put it, services showed no growth in the quarter, which, when you bear in mind that services makes up about 80% of the UK economy, is about as bad as it can possibly get. Although not quite as bad as the construction sector, where activity contracted by 2.1% on a quarter-on-quarter basis, which I believe is the worst output or the biggest fall in output for the sector in over 4 years. So all in all, the figures themselves are downright ugly, and the risks to that continue to tilt to the downside.
No, absolutely. And it's, and this not forget that, this is backwards looking data. This is Q4 2025, etc. This does not take into account the national insurance hikes and the minimum wage increases, etc.
Yes, exactly that.
So, we've got some dampeners to the economy coming through that haven't yet hit. So, and this is why I mentioned before, and I got on my kind of soapbox probably this time, like a couple of months ago, when I kind of said how shameless it is for Labour and specifically the Treasury Rachel Reeves, basically in the face of awful data coming out and saying things have never been better, which is an outright lie. Today, after what was dreadful data, Rachel Reeves, who I quote, goes onto Twitter and goes, Thanks to the choices we've made, we've seen 6 interest rate cuts and inflation is falling. We have the right economic plan to build a stronger, more secure economy, cutting the cost of living, cutting national debt, and creating conditions for growth. Well, you're not doing any of those things. And
It's just a lie.
in fact, yes, the Bank of England are being forced to cut rates. The one thing, she is correct. The Bank of England, it's due to the choices that she's made, which is meant
So they're being forced to cut
they
rates.
are being forced to cut rates, but the reason they're cutting rates is because of the deteriorating economic outlook. And the fact that
Yeah.
she's sitting there and Labour MPs are basically, they're not. I like to think that Labour MPs, etc., they're not stupid. Even though she's no BOE economist, right? Let's make that very clear. But she must know that, one, why the interest rates are being cut, and two, she must know today's data was dreadful, and yet they come out, and it's one thing trying to, and I've said this before, I think there's a distinct difference between trying to massage kind of the messaging and say, look, things are going to get better, we will make some changes, and that kind of, cover for poor data. But this is outright lying.
It is.
This is outright lying to people's faces, telling you this is absolute gaslighting, and that's what's really fucking me off, to be honest.
Well, no, and I completely agree with you. And actually, Keir Starmer, the Prime Minister, has put out a similar thing. He said on Twitter this morning, I quote, "I know there's more to do, but we are heading in the right direction." Well, that's just complete and utter nonsense. Simon French at Panmure Liberum, as they are now, if you're not following him, do so, because he put out a very good chart this morning, which noted three things, actually. The first is that GDP per capita, so on a per head basis, has now fallen for 2 consecutive quarters. Now, that's not a definition of a technical recession. That is overall GDP contracting for 2 consecutive quarters, but it still ain't a particularly rosy sign, if we're being honest with you. And the second point is that we have now had, as he mentions, 5 quarters of post-election data in terms of how the UK economy is performing. And on both a GDP and a GDP per capita basis, in those 5 quarters, the UK economy is tracking below the average of the prior 14 years, obviously starting with the coalition and then into the Tory administrations of Cameron, Boris, etc. So for the government to come out and say we're heading in the right direction, you're not. For the government to say we've got a plan and it's working, it clearly isn't, because you're performing worse than your predecessors, who literally an hour ago, one of your junior ministers was on Bloomberg moaning about. So it's frankly shameful and shameless that they are coming out with these lines in public. And although we have seen a bit of an uptick in some of the activity data to start the year, we had obviously those better than expected PMI figures last month for January, and we get the latest flash PMIs next week. It's really tough to actually see that uptick being sustained based on all of the downside risks that are coming down the track.
Yeah, exactly that, my friend. Exactly that. But let's move on from that before we end up, really getting heated. Michael,
Or being taken to the tower, one or the other.
Well, quite. Just me, you, Larry the cat, and that's it. What else have we got to look forward to today?
Yeah, it is quite a barren data docket once more, actually, today. We did get the weekly US jobless claims numbers at 1:30 this afternoon. Initial claims seen falling to 223,000, down from a prior 231. Do bear in mind, of course, that the prior print was skewed higher by all of that cold weather that they've been having in the United States recently, so there may be a bit of an unwind of that. Continuing claims, meanwhile, expected broadly unchanged at 1.85 million, although remember that neither of those prints pertains to the February non-farm payrolls survey week. Other than that, we do get existing home sales data around the states. Home sales in January expected at 4.15 million, down from a prior 4.35 million. Besides that, we round out this week's Treasury supply with a 30-year bond auction this evening, 6:00 London time. We're due to hear from a whole host of ECB speakers, including the chief economist Philip Lane, although it's doubtful that any of them will say anything of much interest. And on the earnings front today, there's nothing of particular note before the market open, but after the close this evening, we hear from the likes of Pinterest, and for all the crypto folk out there, Coinbase report on the closing bell as well. But that is all from me this morning.
Wonderful. Well, Michael, thank you very much as always. Listeners, thank you so much as always. We do appreciate you coming along and joining us for the ride. Whatever you're doing today, keep it tight, stay safe, and we will see you tomorrow for the last show of the week.